and maybe forever. Who knows? If I knew, I guess I'd bet against it. But that's what I think about.
All right. Yeah, I want to keep you on the hot seat for one more second. In terms of what you're doing, selling loans, I know you've really got your finger on the pulse of the pricing. You want to talk a little bit about the bid-ask spread, what's going on, how these, give us some thoughts on the debt side, how the paper's trading?
Sure. I mean, they're still in some asset classes and certainly some specific assets remains a bid-ask spread. It's come down. It's come down a lot. It's kind of a function, I think, of kind of a tale of two cities. On one hand, you have the cash flowing, maybe Class A assets, good locations where pricing has rebounded. It's rebounded a lot. I think some of us up here maybe think too much. On the other hand, you have sort of labor-intensive, maybe smaller, Class C, non-cash flowing assets. Those assets have moved. They're continuing to move. They continue to and they will continue to move. There, I think it's less of a pricing bump, although in certain markets they have come up, sometimes a little, sometimes a lot, and just kind of time, right? Time goes on, they get marked down a little bit more. Maybe they move from a loan to REO, a little more incentive to sell. It's been on the books for 2 years. Now it's time to move. But in almost all cases, every quarter that goes by, maybe the buy side comes up a little bit, the sell side comes down a little bit, and now deals start to happen. And it's not that you don't have to sift through hundreds, maybe thousands of deals. I mean, we might sell 10, 15% of what we look at, but there are a lot of deals out there to be done.
Okay. For two gentlemen on the buy side, where are the good deals? What sectors, what markets? What are you focusing on?
Well, we really focus primarily on office buildings, so I don't spend a lot of time thinking about multifamily or retail or hotels. But we're really believers in quality. In this part of the cycle, markets that are supply constrained, high barrier to entry, higher quality assets. I think there's a real shift. In sort of corporate America, and tenants where they want to be, they want visibility, they want quality, they want green buildings more than ever now, and pricing is not as big of a consideration. So our strategy is to try to lean into that. We like in terms of distress, actually, the Northeast is not nearly as distressed as as other markets around the country. The Southeast, Southwest, for example. But I still think, there are pockets of distress in the Northeast, and there's, a lot of people that, paid record prices for assets in the Northeast in 2007 that are just completely upside down on their capital stack. And, that's where the opportunity is going to be for us. So it may not be that the asset is so distressed or the market is so distressed, but the capital structure and the ownership is distressed. And that's where we're going to try to, make our bets in the next couple of years. Out on the West Coast, I like the dynamics in San Francisco. Some similarities actually to the Boston market, and I think LA is less supply constrained, and you got to be a little more careful out there.
All right, before I turn it over to Paul, I've got Jeff with a microphone in front of him. Let's talk just for a minute on the Hancock Tower. Okay, how did you do it, and sure. What were the important considerations for you as an investor?
Well, I mean, that you have to look at what was the dynamic in June of '08 when we bought that loan. We had no competition. It was just a direct deal between Normandy, Lehman Brothers, and the Royal Bank of Canada, or Scotland rather, Greenwich Capital. So we sort of had our pick at what we wanted to focus on, and and I think that the theme that we were thinking at the time was actually similar to what I just said. Here was a 6-asset collection of trophy office buildings that a fund that's seeking 18% plus type returns couldn't ever buy in a normal market environment, and we just sort of said, wow, we got to try to get that. And so that was important to us. I think the other thing that, you know, we were sort of looking at, just sort of big picture, longer term, is that when assets go down in price and, you know, in the real estate markets, the ones that come back the fastest when the market turns around is an asset like, you know, the Hancock Tower or 10 UCP on the West Coast, or, you know, some of the other, you know, there was 2 assets in Washington, D.C. I mean, those are the ones that lift first and recover the quickest. And so that was kind of the dynamic that we were, you know, trying to play into. And then the question was valuation. You know, I mean, the risk of catching a falling knife in the middle of 2008 was very, very high. So we really, you know, went out of our way to be conservative in our valuation. And, you know, I think part of it's luck, right? I mean, we could have absolutely overpaid and just sort of, you know, kind of not analyze, you know, how severe the market was going to get. Having said that, 4 of the 6 assets that made up the collateral pool when we made our investment were sold prior to when we actually foreclosed on the Hancock Tower, and all 4 of them either sold at prices equal to or greater than what we underwrote. So, you know, we kind of hit that in our underwriting, and we also benefited from the 2 or 3 assets that actually sold for prices that were higher than what we underwrote. So, you know, that helped a lot. And then, you know, just from a buying into the debt stack, you know, point of view, you know, our challenge was to figure out what's going to be the fulcrum security in this deal. And this was a $723 million mezz loan that we bought a $75 million slice of, and we're sort of relying on, you know, the rights that we had under the underlying docs that we spent literally $1.5 million diligencing with our lawyers before we made the investment, to really understand how are we going to get into this deal, how are we going to get out if things don't go the way we want them to, and if they do go the way that we want them to, how are we going to get to the real estate. So we had a very, you know, clear picture and strategy for how we were going to execute that. You know, what we didn't know was, you know, this was clearly a high-profile CMBS deal. This was, you know, kind of in this cycle, you know, new technology in terms of all these documents, and CMBS market didn't exist in the early 90s, and how was that all going to unfold, and, you know, was this thing going to end up in bankruptcy? What have you, and there was a lot of eyes that, you know, were kind of trained in on this particular transaction because it was one of the first and highest profile situations that was going to go through a foreclosure. And, you know, was the UCC process going to work? Was, you know, Broadway going to file bankruptcy? How was that all going to unfold? And ultimately, we were able to, you know, sort of mitigate all those risks, you know, through negotiation and sort of pave, you know, a pretty smooth path to getting to the real estate. But you know, those were all sort of unknowns when we got into it, and we spent a lot of time and a lot of effort, you know, trying to figure it out. Thankfully, it all worked out. We foreclosed on Hancock Tower, 10 UCP. Hancock Tower in particular was, you know, what was great about it is it had this 10-year interest-only fixed-rate, you know, CMBS loan that was had 7 years of remaining term. It wasn't cross-defaulted with the mezz loan that we bought into that defaulted, so we knew that we could foreclose on the mezz, step in, become the borrower under the senior, and have 7 years of runway to let the market recover and to execute, you know, a turnaround strategy for the Hancock Tower. And, you know, what ended up happening is we got to the real estate. We, you know, very quickly implemented some base building capital improvements that included, you know, adding parking in the building, moving the food cafeteria from the concourse level up to the first floor, you know, kind of sprucing up the lobby. And then, you know, the big coup was attracting Bain Capital for 270,000 square feet out of, you know, a very high quality building in the Back Bay into the Hancock Tower. And then, you know, as you saw the graphs earlier where it shows that trophy buildings have bounced up 35% off the bottoms, you know, that was happening right at the same time we were, you know, executing this turnaround plan and leasing up the building. And so we, you know, sold into that, you know, that recovery, if you will. And it turned out to be a great deal.
All right, before we take questions, Paul, where are you going to place your bets?
So we sort of play on both sides of the market, both in the higher quality, well-located stuff and in the sort of the true value add pieces. And I think that you could separate those today. And what I would just tell people is it's fairly simple. And I think the Hancock is proof of this, is that location has always been, and everybody knows location, location, location. Well, location matters more today than I think it has ever in the real estate business. Be it, you're gonna see build-to-suits in Cambridge, and you're gonna see 495 at 45% vacancy. And the rent differentials of the past don't matter, don't really matter anymore for tenants. So, and those locations exist in almost every market in the country. There is more distress in the Southeast today than there is in the Northeast, but there are markets that do have this distress. And again, it's all about how the piece of real estate fits into what's happening in the area. I mean, we just bought some industrial in Miami that J&J was getting rid of, and the industrial area part of Miami is just on fire. And it's like, you want to be industrial, you want to be down there, and we bought a deal for a very low number that we're going to rent for about a third of what we paid for it per year basis. So it's again location and how that really makes sense. And I think there's going to be a lot available on the low end. The $10 to $20 million deals, there's going to be so many of them with no tenants,
Right.
that somebody screwed up. There's a lot of that real estate out there. And then there's the higher quality, what is a lab building in Cambridge worth today, and how much does it cost to replace the next one?
All right, how much time do I have for questions? All right, questions. You have to speak up if you can.
I'm aspiring to get into commercial real estate. So my question is, I have $500,000 in my pocket. What's the way I can follow to get into owning a big office building in downtown? Or
Right. $500,000 is budget dust to these people.
I know.
Right.
So let's say I have small amount of money.
Right.
Not is there any way I can go up the ladder? Or it's just
You could
has
go
to
on
be
the debt exchange, and
Yeah.
there's a lot of loans and properties that trade through exchanges like that. And if you were going to invest not a large amount of money, that's probably an area where you can be very hands-on and actually not only put some money to work, but work it as a principal, and and make money that way.
basically take the steps, go up a little bit higher up, and
There's a lot of small deals out there, and I'd say get to know a market that you like, point out a blocks or an area, and just go basically and really pursue. There's a lot of small deals. There's not enough people to buy them on the small side basis, and there's going to be a lot of opportunity for that broken retail center next door to something that might work. There's a lot of opportunity.
But I think from the standpoint of what you can do with that money if you're going to leverage it, again, the debt that's available for those distressed properties is more conservative than it used to be. So you're going to be looking at maybe getting 60, 65%, maybe 70 on a loan-to-cost basis.
that solves the problem.
Smaller deals, right? Yes?
Broadly speaking, the quantitative easing policy what are the implications?
Who's to say it's going to come to a close in June?
Well, I mean, that's all I know, right? But what are the implications?
Right. Assuming that the quantitative easing policy ends in June, what are the implications?
So I had a conversation, I asked this question to somebody who runs one of the major endowments in this town for a university. And his answer was, number one, who's to say it's to come to an end? That's number one. And number two, basically, we're in a new world. The Fed seems to be a little bit in a box. They have come out